Wall Street analysts, economists, and financial experts spend millions of dollars trying to predict what happens next. But history teaches us something interesting. Whether it's the dot-com bubble, the housing crisis, the inflation scare, over and over again, when experts agree, you better think twice. Hey everyone, I'm Jeremy Dodd, a certified financial planner and lead advisor with DMI Wealth Management and Insurance Solutions. You know, if you've been watching the news lately, you've probably seen headlines about artificial intelligence, interest rates, geopolitical tensions, and concerns about the economy. And if you're investing for retirement, it's really easy to wonder, should I be worried? Today, I want to walk you through what's driving the market right now and why this environment feels different than previous years. And most importantly, what long-term investors should focus on moving forward. One of the biggest stories driving markets today is artificial intelligence. But what's interesting is that AI isn't simply another technology trend. The complexity has shifted. But think about it this way. Years ago, innovation was started at the creation of fire. Then came electricity, and then products that supported or ran on electricity. Now it's becoming about creating systems that can solve problems on their own. And that's why we're seeing billions of dollars being invested into infrastructure, data centers, semiconductors, and energy production. In fact, right here in Texas, we're seeing major investments in data centers and AI-related infrastructure projects. The market recognizes that AI could fundamentally change productivity across nearly every industry. Now, does that mean every AI company will succeed? Of course not. But it does help explain why investors continue paying close attention to this space. One question we often hear is, what's driving the economy right now? The answer is surprisingly balanced. When we look at the indicators we monitor, many of them remain relatively neutral. We're not seeing extreme optimism. We're not seeing extreme widespread panic. We're seeing an economy that continues to grow while adapting to higher interest rates and changing conditions. But let's start with you, the consumer. Consumer spending remains one of the biggest drivers of the U.S. economy, and even with higher prices and higher interest rates, Americans have continued spending money. People are still traveling, dining out, and making purchases, which has helped support economic growth. The labor market has also remained resilient. While hiring has slowed from the extremely strong pace we saw after the pandemic, unemployment remains relatively low by historical standards, and most people who want a job can still find one. And that's an important foundation for economic stability. Now, let's talk about inflation. Inflation was one of the biggest economic stories over the past several years, but today it's no longer accelerating the way it once was. While prices are still higher than many consumers would like, inflation has moderated significantly from those peak levels. That has shifted investor attention towards interest rates. Markets are continuing to try to figure out when the Federal Reserve might lower rates and how quickly that process could happen. The challenge is that nobody knows exactly when or how aggressive those changes might be. At the same time, corporate America has remained surprisingly strong. Many companies have continued growing earnings despite higher borrowing costs and economic uncertainty. And that's one reason stock markets have remained resilient despite all the negative headlines. So, to recap, some areas remain strong. Corporate profits, credit availability, business investment. Other areas remain mixed. Consumer sentiment, housing, interest rates, labor markets. In other words, the economy isn't firing on all cylinders, but it's also not showing signs of widespread distress. And that is an important distinction. One thing that has changed dramatically is the amount of information investors receive every single day. We live in what I call a headline-driven market. That means every day we're bombarded with news, interest rates, artificial intelligence, elections, international conflicts, and corporate earnings. And because information moves instantly, emotions move instantly too. One headline can make investors feel optimistic. The next can create fear. But there's something worth remembering here. Just because headlines are loud doesn't mean the fundamentals have changed. In fact, one of my favorite market quotes comes from Bob Farrell. When all the experts agree and forecasts agree, something else is going to happen. Markets have always had uncertainty. Today, we simply experience that uncertainty in real time. Another interesting shift is who actually drives market performance. Back in 1980, many of the largest companies were in industries like energy, telecommunications, and manufacturing. By 2000, companies like General Electric, ExxonMobil, Pfizer, Citigroup, and Cisco dominated. Fast forward to today, and the largest companies are largely technology-focused. NVIDIA, Apple, Alphabet, Microsoft, Amazon. And that's a remarkable transformation. The companies leading the market today are fundamentally different than those that led in previous generations. And this reminds me of an important lesson. Markets evolve, industries evolve, innovation evolves. The winners of one decade are not always the winners of the next. So what does all this mean for someone saving for retirement? Honestly, not as much as you might think, because retirement success is still driven by the same fundamentals it always has been driven by. Consistent savings, long-term investing, and staying disciplined through market cycles. Too many investors become focused on predicting the next headline, but retirement readiness really isn't built by predicting headlines. It's built through habits, month after month, year after year, and decade after decade. Let's shift gears for a moment. We've talked about AI, we've talked about the economy, we've talked about markets, but for most people in the room, none of those things are going to ultimately determine whether they have a successful retirement. Most of what matters is participation, consistency, and time. One of the biggest advantages workers have today compared with previous generations is access to an employer-sponsored retirement plan. According to Vanguard's research last year, 54% of those who participate in a defined contribution retirement plan or 401k plan are on track for retirement, while only 28% of those who don't have access are on track. The reality is that retirement success is often less about expertise and more about consistency. Consider two employees. One waits 10 years to start investing because they feel they don't have enough money. The other begins immediately and contributes consistently. Even if it's a relatively small amount, in many cases, the employee who starts earlier ends up with significantly more money because they gave compound growth time to work. Albert Einstein reportedly called compound interest the eighth wonder of the world. Now, whether he actually said it or not, the principle remains incredibly powerful. Compound growth means you're not only earning returns on the money you contribute, you're earning returns on previous returns and the returns of those returns. So over time, it's a snowball that can become incredibly powerful. As we move through 2026, there's going to continue to be headlines. There will continue to be uncertainty, and there will always be reasons investors can find to worry. But successful investing has never been about predicting every headline. It's about maintaining a long-term perspective and staying focused on the things that you can control. Your savings rate, your investment strategy, your time horizon, and your financial plan. If you'd like help reviewing your retirement strategy or understanding how current market conditions can impact those goals, we'd be happy to have a conversation. Again, I'm Jeremy Dodd, a CFP and lead advisor here with DMI Wealth Management and Insurance Solutions. Thanks for watching, and we'll see you in the next update.